So this is our first bet. Hovenia Enterprises is a company based on New Jersey. They build retail properties and home, especially home houses. So you can see here, they operate in these states, being the largest Texas. It's a company has been in the market for a while. Was founded in 1959, and it creates mostly family houses, single family houses, townhomes, condominiums, and high-end buildings and medium right rise. So why is this company our first bet? For start, I invested in this company 1 year ago, and I'm already making 50%. I didn't capture this 5%. I'm already doing 50% in a year, and it will go up even further. Why? This type of businesses like Hovenian is a business very exposed to macroeconomic trends. As the interest rate goes up, normally the mortgage rate goes up. As the mortgage rate goes up, companies like this got their inventory turnover slower down. What does this mean? As the mortgage rate in the US has been rising for the last 3 years, as we can see, the companies that build houses like Hovenian tend to get their inventory increasing as well, because the demand for houses that people cannot finance because the interest rates got higher and becomes too costly, tends to make the company inventory turnover to slow down. As we can see, this correlated up. The inventory is going up, the value, this is the value in the houses going up as the mortgage rate goes up to 2020, 2021, 2022. 2020, 2021, 2022, as 2023. As we can see, in October the mortgage rate starts to go down, right? As the mortgage rates go down, the inventory turnover goes up. As the inventory turnover goes up, what does this mean? It means that the demand for houses, because it got cheaper to build houses, to buy houses, and to sell houses, because people have to finance those houses. As the demand is more rapidly increased than the supply, the company cannot build large amount of houses in 3 months. So the company cash flows has to increase. Why? Because their houses are turning over much faster. They can spend this money, right, to increase the amount of houses they are selling. So as the interest rate goes down, mortgage rate goes down, inventory turnover goes up, so free cash flow goes up. As they try to build new houses for the company, their profits go up, and this will affect the shares. As we can see here, is already going up from this year, right? It will go up any further. This company was so undervalued that it made in the last 5 years a impressive return, as we can see here. The stock start trading to $12 and is now at 192, but my expectations is to go up As now now with this interest, with this mortgage rate, the value of the company 250, right? As the inventory turnover goes up and profits goes up, I expected this company to get to the shares to 300 to 90, and is a impressive company, very well managed, great ROIC. Even in abnormal market conditions, the mortgage rates is very high. It's higher than it's ever been for the last 10 years almost, and the company is still making large free cash flows, large sums of money, and the value is greatly undervalued. So this is the our first bet, is a guarantee bet. Already made 50% in a year and expected to do 100% in the next 2 years easily. So this is our first bet, Halvanian Enterprises housing. So this is our second company, ticker 1, CVR Partners. Is currently trading at 67. It's a farming, is working in the farming industry. It does fertilizers. So let me speed up. This company has been punished due to the conflict. The largest producer of natural gas in the world is Russia, and in Ukraine has a pretty big participation on natural gas. Natural gas is related to fertilizer because 80% of what is used to produce a fertilizer is natural gas. To a chemical process, harsh boss, if I'm not mistaken, we can turn natural gas in in ammonia. In ammonia, we can do the website is mostly off. We can do with ammonia. We can do nitrogen fertilizer. Yes. So what's the problem? Let me show you. As the conflict spikes in around this date, the supply chain of natural gas is disrupted, right? So here's a downfall in this. Here the conflict starts. As the conflict starts, the supply of gas got decreased. So the price of gas went up. When the price of gas went up, other producers that don't have as shallow gas in their land, as the price spike ups, can drill further on the ground, which is costly. But as the price is high, they can drill further in the ground and extract the gas. So all the producers that cannot produce that much gas when the value is around here can produce that gas when the value of the BTU of the gas is here. So all of them start drilling to capture as much value of they can of their extraction. What happens then? Everyone is producing around the clock, so the price tanks, right? So if we do a comparison here between natural gas and urea, which the main thing in fertilizers, you can see there is correlation. Let me show you long-term correlation, almost exactly the same. But as the price went up on natural gas, the price of fertilizer goes up. Why? Because as natural gas gets drilled and is 80% of the production, people cannot produce. As natural gas rise up and it costs 80% of the production, people cannot produce as much fertilizer because it's expensive. So there is scarcity of fertilizer, and the value goes up. As the value goes up, people tend, those who can, like Russia and Ukraine and other countries that has shallow natural gas reserves, like Saudi Arabia and similar, they start to produce more gas, drill more holes to get more gas to capture this spike. So they, but every single player in the market is doing the same. So they, in time, they oversupply. As they oversupply, the price tanks down, and then the price of gas got constantly. So if you look at here the last 5 years, you're gonna see a mismatch between gas and ammonia. That's the urea that can do ammonia fertilizer. So as this mismatch the gas price, what happened here, the stock falls down. If you can see is below the average, 10-year average, right? So when this happens, oversupply, price tanks, value tanks, shares tanks. However, this is unsustainable because is lower than what you produce. So what will happen? As the value of the gas goes down, the price of the ammonia fertilizer goes down. As the price of ammonia goes down, the profits of the companies goes down. However, if the company doesn't have, in this market, doesn't have a stronger balance sheet, they put out of market, or they start to drill less. Let me show you. If the company doesn't have a strong balance sheet, their debts really close to their assets, and they have no cash flow, no operational cash flow to tank their interest payments, they have to sell machinery, lay off some people, or stop drilling. As they stop drilling, the price will shoot up again. As they stop drilling, the price will start to come up, and the price of the fertilizer will start to go up as well. So is the price of natural gas already tanked? The greatest two suppliers of natural gas and fertilizer are in conflict. So the supply of those who control the market, like OPEC controls the market for oil, so this decay is because of oversupply, because the value of this time is because of the conflict. So there's a over spike because of scarcity of the product, then is a oversupply, then thanks the stock, thanks the price of oil, because and now the market rearrange itself. As we can see here, in the 25 years, you can see the spikes, oversupply, spikes, oversupply, spikes, oversupply, spikes, oversupply. So here's the oversupply part. As we buy the stock here, of course, if the company is undervalued, if the stock tanks down, but the company is not overvalued, there's no guarantee they will shoot up when the scarcity of the good happens again. But in this case, the company is undervalued, and they are in the low phase of the economic cycle. So probably in the next 2 to 3 years, this will be corrected, and the company is undervalued and will shoot up. Both of them will shoot up and will make a large profit. The company now, for my analysis, is worth $138 and is currently at 67. Is a strong balance sheet for the industry, stronger balance sheet. Probably as Russia and Ukraine cannot sell the is an American company. So as Russia and Ukraine cannot supply other countries with their their products in fertilizer, other companies will take their market share, like this one in America. As the value of the currency dollar is stronger, so they have to buy it cheaper to produce gas. Of course, the commodities are all controlled by the market, so it's all in dollars, but their operation is in dollars as well. So Brazil, the country where I'm from, is a great buyer of fertilizers, and you can see already the overstocking of fertilizers for the farmers. I'm in Rio Grande do Sul. There is a state, there's a production state from soybeans here in Brazil, and the farmers are already overstocking because the fertilizer is so cheap. So as they're overstocking the fertilizers, because this oversupply drop the price, it will start to come down, and the value will start to go up, and then we can capture almost all the profits that we'll make from this oversupply in the market. So this is our second bet, CVR Partners. Great company, great cash flow, great economics, undervalued. Their capex, let's see their capex. They were drilling as crazy, but not that crazy. So as we can see here, there was a reduction in capex, so they are not drilling as much. But as natural gas supply normalizes, you can see a resurgence of the value of the ammonium nitrate and other fertilizers. So this is our second bet, CVR Partners, ticker 1. Our last one for this video, because I talk too much, is going to be too long. I will post a part 2, but our last one in this video is interactive brokers. Interactive brokers, as the name say, is a brokerage firm who is currently trading at 122. Yes, this company I bought a year ago, and I didn't capture this 29%. I am doing now 23 and a half, I think. Is surely is lower than I thought it would be, but probably it's because of the interest rates. American interest rates are up, so this prevents the company stocks to go up as well, because is highly connected with the financial system. So as the government tries to cut the supply of money, reduce the supply of money to the elevation of the interest rates, financial companies tends to be slow down, drag it up, and they cannot share their true value. But as interest rates goes down, as the Fed lower interest rates and economic boom starts to happen, those financial companies will, if you buy it, the right one, undervalued ones, will express their value. So let me show you. Interactive Brokers is a company that works in the brokerage business all over the world. They sell research, orders, free trading. They always rent your stock to sell to other person as an option, and they do mostly these types of business. They operate in half of the world, have professional pricing, good technology. It's all good platform. It's an overall good company, but the financials is the part that makes them stand out. As we can see here in the balance sheet, in first look you say, oh, the balance sheet are not that close for a financial service, because all the money in a bank or other financial companies, all the money that you take from a client to put to use, you also owe to the client plus interest. So if you have a company that borrows from the client, a bank for example, 100 mil, they have to pay the client 100 mil and 10 in a year. So the liability side of the balance sheet and the total asset side of the balance sheet mostly are closely related. What is the matter with the financial companies? What is the hard thing to to get is the risk of the operations that they're doing. Like you have Lehman Brothers that went bankrupt, the risk of the operations, and the operations they are doing are not that risky. There are some dividends, some derivative trading, but it's not that much significantly. The amount of cash they do, it comes from operations. And from operations, of course, their operation is investing, but the investment of money, as we can see, here in the financial, is not that expressive. They don't pay a lot of financial charges. They don't pay a lot of interest expense on their own financial uh, operations. They only pay the interest rates for the clients, as they have to reimburse the client with some interest because they borrowing their shares. And is a overall good company, not over leveraged. The debt is mostly with the currencies, the people who use their services. As we can see here, they have a short-term debt that is great, because the people can withdraw their money anytime they want. So that's why the current liability is so large, but it's not a problem. The regulatory cash is safe, and they are undervalued. Basically, a financial service, you go straight for the return on equity, because you cannot with some certainty define their return on invested capital, because the capital that is invested in generating returns is other people's capital, because they have eventually to give them back to them. So the part of the analysis doesn't work. You have to go straight to the equity part, the side of the partners. The company is being very closely related. Free cash flow is reduced because of COVID. They increased the value of the company, the amount of money they were making in COVID, because people probably are trading more because they're stuck at home, and then this normalize. As the current free cash flow and profits of the company, if you measure for risk and take all the things into account, the company is worth 310, if I'm not mistaken. Yes, 310, and makes more money if this amount of money, if the correction for risk with the amount of free cash flow they are doing, the stock should be at least 280 to be fair value. So extremely undervalued, is well managed, looks like well managed, not get leverage positions, but a huge amount of their own money to provide a cushion against any mass withdrawal of the money, so they don't go bankrupt. So not much to tell here. This company is in a uptrend, and very consistently uptrend, is still undervalued. uh, Great management, not much risk for a financial service, not extremely leverage or doing some shenanigans with derivatives and in risk taking. So is money wise is undervalued. As we can see, make constant, the profits are go the top of the line has been going up. uh, is some services not that correlated to the top of the line. As the income rise, the cost doesn't rise, the variable cost doesn't rise as much. That is great to see. And he will do a kicker. As the American interest rates goes down, this company will show their value, and we can make a large profit on this one. Already made in 23% ish. So I hope the interest rate gets lowered in the next two years, as the money supply is under control, and this financial service can express true value, and the stock go up, and we can make a profit. So that's for today. I know I promised 6 stocks, but it's gonna be too long, so I will post a part 2 of the video that it will explain the other 3 stocks. Thank you very much. Subscribe to the page, leave a like, a comment, and let's make some money.